Who knew? Equities can go down as well as up as we head into an uncertain election and companies continue their struggle with the coronavirus. This is Bloomberg Wall Street Week. I'm David Westin. This week, contributors Larry Summers of Harvard and Gillian Tett of the Financial Times. University of Chicago professor Austan Goolsbee, Dr. Steve Corwin of York-Presbyterian.
I thought it was unfortunate that the CDC came out with guidelines for less testing. You need more testing.
Congressman Patrick McHenry of North Carolina.
I think the Fed has been the best actor on the global stage.
Kristina Hooper of Invesco, and New York Times CEO Mark Thompson.
There was once a really big market in paid news in America. There's no reason why that market can't be recaptured.
It was a week where almost nothing seemed certain. The presidential race tightened, and markets started to price in worries about what comes in November, or even whether we'd get an answer in November.
This is an election which may not be decided on election night. It may drag on for days, weeks, even months.
It was another week that we didn't get that fiscal stimulus that everyone seems to agree is not only necessary but urgent. The labor market continued to rebound for a fourth month, but it also showed we have a long way to go before we get back to where we were before the pandemic.
We expect a lot of unemployment, a lot of layoffs in the period ahead because companies have announced this.
And it was a week when equities paid attention to none of it, until they did, with new highs followed by a sharp sell-off. So it turns out that all that volatility isn't limited to politics and the pandemic. To take us through that market volatility this week, we welcome now our virtual roundtable with contributor Gillian Tett, Financial Times Editorial Board Chair and Editor-at-Large for the United States, and Kristina Hooper, Invesco Chief Global Market Strategist. So, Kristina, you're the Chief Global Market Strategist. Explain to us what happened with equities, because we have to remember at the beginning of the week, they were shooting the lights out going up, and then they came down a lot on Thursday and Friday.
Well, it seems that a few different issues appeared that really changed sentiment and made it a lot more negative. First, of course, we heard from Mitch McConnell that it seems unlikely that we'll get a fiscal stimulus package anytime soon. And to me, that really was perhaps the biggest issue affecting markets. Of course, there are always concerns about valuations when a stock market, especially the tech sector, has had such a strong rally. But there was something of a perfect storm in terms of a lot of different concerns, including, of course, the presidential election and the potential for a contested election weighing down stocks in the latter part of this week.
So, Gillian, how do you see it? Was it the fundamentals, if you can call that, of the presidential election and not getting a fiscal stimulus? Or was it more the technicals of it just got overbought, particularly in big tech? If you looked at some of the daily moving averages, it was way over.
I think it's a combination of two, but there's something else very important, which is that so much of the recent rally has been driven by the tech sector. And in fact, we have a story up on the Financial Times website right now saying SoftBank unmasked as NASDAQ whale stoking tech rally. What that means is it appears that SoftBank has been buying a lot of options in the markets, which have been essentially fueling that dramatic rally. And partly in reaction to that, you've seen a lot of volatility as people are taking fright. Now, frankly, it's unclear at the moment to what degree that has or has not helped fuel the rally in tech stocks, which has been quite remarkable. But the key point is this. A lot of people don't understand why the market has been essentially diverging so dramatically from the real economy. It's not so much about a V-shaped recovery or a U-shaped. It's about a K-shaped, a capital K, where you've had the economy and markets going in different directions. And there's been a lot of unease about the direction of tech sector. And so the fact you've got this extraordinary type of story coming out and rattling people really reveals the underlying nervousness as people try to make sense of something which actually looks quite odd.
And Gillian, I thought it was interesting this week, we had that K-shaped recovery, which I'd heard about from economists and market analysts, go over into politics as former Vice President Biden actually adopted that as part of his theme, that in fact the middle and the lower are getting worse and the top is going up. But as a practical matter, isn't that largely because of what the Fed has done?
It is largely because of what the Fed has done. That creates uncertainty because, to use a usual cliche, we're in totally uncharted territory right now. And people have never seen this scale of monetary stimulus, and they don't know just how long it can keep supporting asset prices, or, heavens forbid, what will happen when that starts to be withdrawn in the future. So that's certainly a great point of concern. But on top of all that, just to indicate this gnawing sense of anxiety and uncertainty as we look forward, there's a fact that the betting markets are currently putting quite different levels of probability onto a Biden victory from some of the polls that are coming out at the moment. And there is a feeling that perhaps some of the yardsticks we've been using in the past to measure not just the economy, but also the political sphere simply aren't working as well anymore. So and that's before you even start talking about the uncertainty about COVID and whether there's going to be a second wave or not. Because what's happening right now in places like Spain and France should give pause for thought for anyone who thinks we're going to have a quick recovery from this.
Kristina, as we talk about fundamentals, if I can use that word in this context, one of them that came out were those jobs numbers at the end of the week, which I think were quite good. We're down under 10%, well under 10% to 8.4% unemployment. There was about 1.4 million jobs created. Now, we have a long way to go, but shouldn't that be actually buttressing some of the valuations in the marketplace?
Well, yes and no, because while this jobs report was certainly positive from a headline standpoint, if we were to drill down, we'd see that more than 200,000 of the jobs created were from census, our census jobs. So those are very, very temporary in nature. And we also saw leisure and hospitality jobs created a little over 100,000, I think less than 150,000. That's well below the 600,000 plus we saw in July. So those are worrying pieces of data that are in that jobs report. And what it suggests to me, and what we've seen when we look at the mobility data, is that there's something of a slowing of the recovery, which of course could get worse if we do see any sort of a second wave this fall.
So Gillian, which is it, glass half empty or glass half full? I mean, we're going in the right direction. We added well over 1 million jobs last month. At the same time, as Kristina just said, it seems to be slowing down a little bit, and we've got a long way to go. We have something like 11.5, 12 million people less employed today than before the pandemic.
Absolutely, and I can't stress this enough. I think so much optimism and sentiment has been focused on this idea that we're going to have a vaccine soon, and that will basically take us back to normal and everything will go back as it was. The reality is that even if we have a vaccine soon of the sort that the president has been promising, even in the best case circumstances, it will take a long time to be distributed. It's not clear that people will take it. And so the idea the economy rebounds quickly is simply, to my mind, a fantasy. I think we're far more likely to see a pattern which looks like an inverted square root sign or a Nike swoosh, where we've had a rebound because it's almost like a relief unleashing of activity, pent-up activity, but then reality sinks in. Actually, not only is there not clarity around the stimulus package going forward, but a lot of companies have been hanging on, avoiding laying people off, and that is now going to start in earnest. I think the autumn and winter could be pretty tough.
Kristina, despite the somewhat of a sell-off on Thursday and Friday of this week, overall, I think we can agree the levels of equity markets are elevated. Let me give you a tough choice. Is that because, as Gillian just said, they're pricing in a vaccine and really getting past this coronavirus, or is it just the Fed?
Well, it's largely been the Fed, but certainly there is some positive sentiment created by the pricing in of an early vaccine. But let's face it, what the Fed has done has been really extraordinary. And I don't think we should underestimate the impact of Jay Powell's words last week, announcing this change in the inflation targeting policy. It's very, very important. And it really suggests that we could see frothy valuations continue, and we could see stocks rally despite a short-term downturn.
So, Gillian, that's good for stocks. What about for regular old people on the street, for the real economy? Does what the Fed do really trickle down there?
Well, this is an issue which has provoked a lot of tortured, soul-searching debate inside the Federal Reserve and all the other Western central banks, because the reality is that elevating asset prices benefits asset owners, which are overwhelmingly the wealthy. And so you're essentially stoking up more income inequality. And I was in a seminar with a group of senior central bankers this week. And they trotted out the usual argument that, well, the best way to cope with inequality and poverty is to create lots of jobs, and that requires lots of supportive monetary policy. Yeah. And that's kind of true, but you cannot get away from the fact that with stock markets rallying like this, it's the wealthy it's benefiting.
You have to watch about that trickle-down theory. Many thanks now to Gillian Tett of the Financial Times and Kristina Hooper of Invesco for that roundup of a rather eventful week this week in the markets, and what happened also with some jobs numbers that were encouraging. Coming up, we're adding jobs, but at this rate, it will take a long time to get back to anything like full employment. University of Chicago's Austan Goolsbee says the virus is still the boss of us.
The first rule of virus economics is that the only way to fix the economics is to get control of the virus.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The White House was pleased by the strong jobs numbers this week, but there is still weakness under the headline numbers of almost 1.4 million jobs added. We asked Austan Goolsbee, professor of economics at the University of Chicago Booth School of Business, what the numbers really show us about the economy.
If you just unpack it a small amount, the private sector job growth, as opposed to the part that was coming from the government, is actually more than a third smaller than it was last month. So there's not really, to my mind, any evidence that cutting off the unemployment insurance to the people who lost their jobs has accelerated the comeback of employment at all. If you look at the people being laid off newly and filing for unemployment claims on an apples-to-apples basis, they're actually higher this week than they were last week. So I think it's odd to me that they would seize on this as evidence of why they want to cut off relief payments.
So you say, Austan, nobody can say it's bad news to create almost 1.4 million new jobs, but part of the question is what the curve looks like. We still have something like 12 million people less employed than before the pandemic, and the question is, how long is it going to take to get those people back to work, and is that deadline getting stretched out farther into the future?
That's what it feels like. Look, that you have highlighted exactly the critical question, which is we've had a nice rebound of what were the temporary layoffs. So again, if you look at this report, you've got strong jobs growth, especially strong in temporary census employment from the government. That was 300 and something thousand. And then the two major sectors of job growth are retail and leisure and hospitality, where you saw the giant increases of temporary layoffs. Those people are mostly now all the way back or pretty close to back. The question is, for the permanent layoffs, can we get them back to work? And if we recover to something like half where we were before, that's not really great. And so I think on the political side, we're going to be in this dynamic where representatives of the Trump administration are clearly going to say, well, look, we're having strong months. And I think other analysts are going to look at it and say, yeah, but the strength is getting weaker every month, and we're not even getting remotely close to where we were even before the COVID recession began.
So, Austan, in your estimation, what is it going to take to get us to the goal we all share, Republicans and Democrats alike, of really getting back to or close to full employment? Is it a matter of that fiscal stimulus that seems to be hung up in Congress?
Yeah, look, I think everything has to do with that virus. As I've said from the beginning, the virus is the boss, and the first rule of virus economics is that the only way to fix the economics is to get control of the virus. You've seen that in other countries where they've slowed the spread of the virus dramatically more than we have, and their economies are rebounding actually faster than ours is. So hopefully we can get control of that, and if we do, I think that we could get on a faster path back to where we were and growing like we were before. If we don't, look, we need relief. But we shouldn't kid ourselves that relief and rescue payments, trying to keep people from being evicted, is going to fix the economy. It's not. I mean, we got to get the engine going again.
Austan, we obviously have been through a crisis from the coronavirus and then following on that, the economy. Everybody wants to get back to where we were. I'm not sure we'll ever get back to exactly where we were. We've made some permanent changes effectively in the economy. How can we come back to a better place? It seems to me that's the critical question. Is there any way to use this crisis to be better and stronger coming out of it than when we went in?
Yeah, let's hope so. Thus far, I'd say, to me, it seems like it's gone a little bit the opposite, that a bunch of the pathologies that we liked the least about the economy and in some ways have gotten worse in this crisis. So the inequality problem has clearly gotten worse. High-income occupations tend to be ones that you can do from home, and lower-income occupations, you have to be in the physical location. So they've been hit harder, and they were already getting hit harder before this started. I think if we could come together, if we could get some national unity on priorities, I think that in itself would be an accomplishment on the political side. On the economic side, I don't totally know how you make it come back better. Remember, we were adding 200,000 jobs a month for years before this crisis began. So our aspiration has to be to do something more than just get back to the employment levels we were at before this started. You know, it's 6 months later, we want to be 1 million plus jobs ahead of where we were.
That was Austan Goolsbee, former chairman of the National Council of Economic Advisors under President Obama, and now an advisor to the 2020 Biden-Harris campaign. Coming up, we've lost all those jobs because of the coronavirus and the shutdowns it triggered. Dr. Steve Corwin of York-Presbyterian has fought the virus successfully, but says we're not out of the woods yet.
Maintenance of masks, maintenance of social distancing, getting the infection number down will allow us to cautiously reopen the economy.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. First, it was New York and New Jersey, then California and Texas. And now the coronavirus crisis has moved on to the Midwest. The question is, what comes next? And what can we do to make sure we can get the economy going again safely? Which is what we asked Dr. Steve Corwin, CEO of York-Presbyterian, the largest hospital group in the New York area.
I think that we missed the boat a little, quite frankly, in terms of not tamping down the infection number. I think we had the debate over masks, social distancing. I don't think that helped us as a country. We politicized it, which was unfortunate. But I think that maintenance of masks, maintenance of social distancing, getting the infection number down will allow us to cautiously reopen the economy. As we're doing. Look, we have to reopen the economy. We can't stay still forever, but you want to do it in as prudent a manner as possible. You read in the Financial Times today, as well as other venues, that Germany thinks that they're having a V-shaped recovery. Part of that is because they were able to control the pandemic to a greater extent than we have. So I think that the two go hand in glove.
Are we making good progress on the testing front? You mentioned testing, and it seems like almost every day we have a new report, like Abbott Labs has something out that takes 15 minutes and doesn't cost very much money. Are we making substantial progress on testing?
Not as much as I would like. We still have issues with reagent shortages and things of that nature, so we can't do as much testing as we would like. But let's just talk about the point-of-care testing for a moment. Some of the point-of-care tests can do a test every 15 minutes. That's 4 tests an hour. The machines that we have made by Cepheid, Roche, and others, we can do batch testing where we can do thousands of tests a day. So if we had the reagents for it, with these machines, we can do turnaround in less than 24 hours, and we can get these things done quickly. The public ought to be mindful that point-of-care testing sounds great, but ultimately you want to be able to do a high volume of tests on a frequent basis. You want a low enough level of infection so that if you identify an infection, you can do contact tracing and then test the contact traces in a 3 to 5 day period to make sure they're not infected. That's the key. I thought it was unfortunate that the CDC came out with guidelines for less testing. You need more testing, and I don't think there's much dispute, at least in the scientific community and the people I've been speaking to, about that.
Well, I wonder about that. I mean, you're a doctor. You head up one of the major hospitals in the country. You can sort of sift through this. For those of us out here in the real world, how do we figure out what the truth is? Because as you say, CDC came out and said you don't need to test people who are asymptomatic. We had a flurry of people, experts, come out and say, no, that's not right at all. Are they undermining their own credibility to some extent? And then we have this convalescent plasma thing where the government says it's just fine. Now we hear NIH says, well, I'm not sure we know.
I think it was very unfortunate, and it does undermine the credibility of the FDA and the CDC. The FDA mistake was egregious. It should never have happened. You're talking about a subset of patients, and you're talking about a misrepresentation of the statistics, even according to the people who did the study. And that then, so what are the consequences of that? Then that gets everyone to say, I want convalescent plasma, as opposed to let's study this more rigorously and see whether it works or not. And we got into that same conundrum with hydroxychloroquine. So I think that was very unfortunate. I think the CDC, quite frankly, that was unfortunate as well. The simple answer is we need to rigorously test various therapies to see if they work. We need to do the rigorous testing on the phase 3 of the vaccine trials to make sure that if we're going to inoculate and mass inoculate, that works. And there can't be any appearance that this is politicized.
Dr. Corwin, you, of course, are a physician, and you were chief of medicine before you were CEO, but you are CEO now, and you've got a really big company, a business to run. You've said before that your company may lose as much as $1 billion out of operating income because of the coronavirus this year. How are you doing financially? And in particular, there was $100 billion appropriated in the CARES Act to go to hospitals. Did you see some of that money?
We did. We'll lose in the $200 to $300 million range through June, and that's far less than we would have lost had we not received the CARES money. We've advocated that the Medicare advances for all hospitals around the country, rural and otherwise, be converted into grants. That would help as well. We still are anticipating a loss anywhere between $700 million and $1 billion towards the end of the year. I do have concerns about critical access hospitals, rural hospitals, and safety net hospitals that do not have that ability. And so, as with other industries, I think you're going to be seeing a shakeout in this fall in terms of layoffs and potentially even bankruptcies, especially if the economy is not coming back and more people are out of jobs. That comes to the negative on the hospital side. So I still think the hospital industry is not by any means out of the woods.
That was Dr. Steve Corwin, CEO of New York-Presbyterian. Coming up, a tsunami hit the news media over the last few years, taking much of the newspaper industry with it. We talk with the man who led the New York Times not just to survive, but to thrive, Mark Thompson, its CEO, through a remarkable and a remarkably challenging time.
Nobody could take a kind of horse carriage factory and turn it into a car company without vast fresh investment.
This is Wall Street Week on Bloomberg. Many traditional print newspapers have been driven to the point of extinction as online offerings from companies like Google and Facebook draw audiences away, and with them, the advertising dollars that are their life's blood.
We have always focused on providing users the most relevant information, and we rely on that trust for users to come back to Google every day. In fact, a vast majority of queries in Google, we don't show ads at all.
About 70% of Alphabet's revenue comes from advertising. Meanwhile, ad sales are slumping at traditional newspaper chains like Gannett and Tribune. Gannett reported a 45% decline in print advertising last quarter. Some of the largest newspaper groups have been driven into the arms of hedge funds and private equity. with McClatchy, owner of newspapers like the Miami Herald and the Kansas City Star, selling to Chatham Asset Management after it filed for bankruptcy protection in February.
For the average newspaper, it's going to be like passenger trains. There are going to be many, many important cities that just don't even have them.
Even Warren Buffett, a long-term and very loyal newspaper investor, has been driven to throw in the towel.
The world has really changed in the media and communications world. I love newspapers, but that doesn't mean I think they're going to do well financially.
In January, Buffett's Berkshire Hathaway gave up on the struggling business after selling its portfolio of 31 local newspapers for $140 million in cash to publisher Lee Enterprises. The pandemic is making a bad situation even worse for local newspapers. According to the Financial Times, at least 38,000 news workers in the United States, from journalists to commercial staff, have been furloughed, laid off, or taken pay cuts since March.
I personally, unfortunately, think that we will see another significant wave of bankruptcies across corporate America as that plays out.
But for all the difficulties experienced by most of the traditional newspaper business, the New York Times over the past 8 years has managed to embrace the future. And we asked its CEO, Mark Thompson, how he went about doing it.
There were 4 revenue streams when I arrived at the company, still are today. Print advertising, which once had been more than 80% of the total revenue of the company had been print advertising, print subscription, digital advertising and digital subscription. And really, my kind of beady eye narrowed in on digital subscription as the revenue stream we should really grow, and indeed had to grow, because ultimately, for different reasons, all of the other revenue streams, it seemed to me, were in trouble potentially, and ultimately might even disappear.
Most newspaper people, as you and I both know, in the United States had said, look, we made the mistake early on of making this free on the internet. There's no way we can charge with it. With the possible exception of the Financial Times, maybe the Wall Street Journal, because it's a specialty business publication. So what you did may have been simple, but it was not what most people thought would work.
That's true of our industry, but if you step back, I mean, Reed Hastings was thinking the same thought about high quality TV in relation to Netflix. Daniel Ek and co at Spotify were thinking the same about music, that there was a way of getting great entertainment or great music to the world's public, and enough people out there would pay for it to make a great business. And really, all we're really doing, I think we're part of a broader trend towards direct digital subscription relationships with people who want really good stuff. And that's an entire sector which is growing very rapidly. There was once a really big market in paid news in America. And it wasn't just the New York Times, it was local newspapers, it was metros, it was magazines and all the rest of it. People paid billions and billions of dollars as subscribers and buying these products from newsstands. There's no reason why that market can't be recaptured, it seems to me.
But how would that happen, Mark, as a practical matter? Because when you came in, the New York Times still had a very robust newsroom, directed toward print largely, but a very robust newsroom. A lot of newspapers across the country, these are regional as well as local papers, really have had to cut back so far. They've let those newsrooms go. Is it possible at this point to rebuild that? Can your model apply beyond the New York Times, I guess is what I'm asking.
And the answer is, because so few people have even tried it, I don't think we know. But to me, I mean, I think there's one basic big caveat, which is this is a kind of horse and buggy to automobile moment. And that requires capital. You have to risk some money, you have to invest to make the change. But assuming someone wants to invest, I don't see at all why, if you rehire your journalists, rebuild that newsroom, start doing great reporting, and start getting smart about how you get it to the public, why you can't rebuild a new business. I think the mistake made was thinking that you could kind of eke your way to the digital future without putting any fresh money in. And no one could do that. Nobody could take a kind of horse carriage factory and turn it into a car company without vast fresh investment. And This is one of those periods in media which is very capital intensive. It requires lots of money, but for people who are prepared to put the money in, I think there are great businesses to be built.
But the other thing we saw was people take a look at Facebook and Google and say they're so massive, their audience is so large, we have no choice but to go through them. We have to hitch our wagon to them, even though they will have the direct relationship with our subscriber, our customer. I mean, even New York Times flirted with that for a time. So is it possible for you to do this directly? I mean, you have a direct relation to the subscriber.
And we believe that although digital social media, Facebook and the rest of it, Google search, and all of these platforms are really important in people finding our content, hearing about the Times and making sure our journalism is really influential, that we really needed a kind of trail of breadcrumbs from these other platforms back to the mothership, back to the New York Times experience. And we need to get smart about guiding people. So even if they heard about us, found about us, read their first pieces on these platforms, more and more they'd come to us. And to your broader point, I want to say that a few years ago, recorded music went through a very similar kind of complete crisis of confidence and assumed that other people, they worried about Apple, they worried about pirates, they worried about YouTube and so on. Other people, in the end, were so powerful they couldn't rebuild their business. But about 2 or 3 years ago, I think 2017, the global recorded music industry started growing its revenue again. Hasn't got back to its peak yet, but that's now looking like a strong industry. And there's no reason why the news industry can't bottom out and start rebuilding.
Mark, we do have an election coming up this fall. You may have noticed.
I've heard that.
Exactly. And I wonder what you think about covering this election. I mean, things have gotten more and more partisan, more and more divided in this country. You come from Great Britain, and certainly the BBC really tries to be neutral, even though the government may not always agree that it's neutral. But on the other hand, you have newspapers that are decidedly partisan. Is there still room for an impartial newspaper here? Let's be honest. Some people think the New York Times already has moved left of center.
Well, in its opinion pages, and in particular in its editorials, the New York Times does host opinions and its own editorials, its leader columns, as it were, the opinion of the New York Times, or at least its editorial board, does definitely lean left. In its news pages, it strives to be very objective. But and you know this as well as I do, to someone who's got very strong political opinions, who's got a very clear ideology, impartial looks partial. Impartial looks like it's hostile because it's not agreeing with everything you believe and you say. And the truth is, when politics are very polarized, almost no one wants impartial news. What they really want is news which helps their side. My view is we just have to be patient.
That was Mark Thompson, outgoing CEO of the New York Times Company. Coming up, breathing more life into the economy. The Fed has done what it can do. What do we need from the Congress? We talk with Republican Congressman Patrick McHenry of North Carolina.
Fiscal support is necessary because of the voluntary shutdown of our economy.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. The Federal Reserve has done what it can do to backstop the equity markets, and so far it has largely worked, despite some of the volatility that we saw this week. But economists and lawmakers keep warning that the underlying economy needs something more than just the Fed. It needs more fiscal help, something we talked with Republican Congressman Patrick McHenry of North Carolina about.
I agree with the Fed assessment. And especially, you hear from Richmond Fed President Barkin explaining that fiscal support is necessary because of the voluntary shutdown of our economy. And small businesses are still hurting. We've got a lot of employees that can't work from home that are really struggling. And I think it's necessary for us to have a deal. Sadly, though, this distant from a presidential election, 2 months from a presidential election, I think Speaker Pelosi and Senator Schumer are doing much more the bidding of Joe Biden's candidacy than the bidding of the American economy here. And so this has gotten caught up in presidential elections and control of the House and the Senate as well, sadly.
Well, do the Democrats have the upper hand in the sense that we do have the election coming up, and if things really crater between now and then, it could hurt the incumbent?
Oh, for sure. And that is to their advantage, and that's how I see it. And like you said, I'm a Republican member of Congress, so let's be honest, I've got my perspective. But to follow this process closely, Speaker Pelosi has a majority in the House. She's produced a $3.5 trillion spending bill, which is the largest spending bill in American history. And what Mitch McConnell and Secretary Mnuchin, on behalf of the administration, offered was the second largest spending bill in American history. And somehow that's not sufficient. So I have to step back and say, what's the game here? And quite frankly, we know the polls are tightening on the presidential election. The control of the Senate, control of the House is at stake. And so I think it's gotten wrapped up in that in their mind's eye. And sadly, the American people are the ones that are going to be punished as a result of this.
So that's on the fiscal front. Can monetary policy pull us through? We heard from the Fed last week. They're changing their approach. They're going to tolerate somewhat higher inflation, I think it's fair to say, as well as really emphasizing full employment. Do you agree with that approach? And is that going to be enough?
Well, I think the Fed has been the best actor on the global stage. I mean, I think the Federal Reserve and the leadership of Jay Powell is to be commended. They acted decisively, they acted early, and they stood up more programs in a period of 3 months than they stood up in the fullness of the last financial crisis. So they are to be commended for their actions. And the reassessment a decade after the financial crisis of the Fed's sort of going forward analysis and what they're forecasting for the economy and how they want to look at the economy, I think is necessary. And I think this Fed has put a new stamp on the direction of the Fed for the next decade. And I think that is a positive thing for the American worker, for the American economy, and for American exports.
That was Congressman Patrick McHenry, ranking member of the House Financial Services Committee. Coming up, we wrap up the week with special contributor Larry Summers of Harvard. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. It was a week of ups and downs and sometimes just plain moving sideways. To wrap it up for us, we welcome now our special contributor and former Treasury Secretary Larry Summers of Harvard. So, Larry, we had a lot of information on the stock market toward the end of the week. I mean, on the early week, it was going up. The latter part of the week, it really sold off quite a bit. How much of this is signal and how much of this is noise, to borrow from Nate Silver?
You know, David, Bob Rubin famously told everybody in the Clinton White House, markets go up, markets go down. I think it's a mistake always to make judgments about deep and profound things, even about the future of markets, from how they behave over a period of several days. So I'd be very surprised if the events of the last couple days are historically memorable. My son, who's in his mid-20s, sent me a note in the middle of the day yesterday saying, hell of a correction, Dad. And I wrote back, by the standards of your young life. And he had the good grace to write back, fair enough. So I don't know where markets are. I have come to think that the idea that many had early on, how can the markets be so strong in the midst of a COVID shock so big? I think that idea that treats the divergence as overwhelming evidence that markets are wrong is misguided. You would expect that when interest rates were reduced as much as they have, when the Fed is as freely providing liquidity, when action is shifting towards technology companies, you'd expect to see a variety of the things we've seen. Are they overdone? Are the movements overdone? What fraction of that has been corrected in the last couple days? Each investor will have to make their own judgment. But just as every time it starts to snow, it's not a blizzard, though it might be. Every time you have a significant market move, it's not the beginning of something profound. So I think people should be worried about whether we're going to carry on an honest election in the United States. They should be worried about whether we're going to have a competent effort, which in many ways we haven't so far, to contain COVID. They should be worried about whether we're going to find a way of making our economy function so it helps middle-class people and a large fraction of the population shares in any prosperity that's created. I think the fundamentals are the more important things to be worried about than this particular market fluctuation, which I think is unlikely to be long remembered.
Larry, there's a lot of talk this week as there was a sell-off led by big tech that this might look like 2000. But as you pointed out to me, it's very different in part because of what you just pointed out, which is the central bank liquidity being infused into the marketplace, as well as the fact that the big tech companies aren't making a lot of money, unlike some of those tech high flyers back in 2000.
Yeah, I don't think you were talking about pets.com in 2000. You were talking about an era when people raised money before they had their first dollar of profits, before they had their first dollar of revenues, before they had their first coherent plan. I think when you're talking about the largest companies in the marketplace, which is what the tech companies now are, you're looking at something very different than what we were looking at in 2000. And if you look at price earnings ratios, they're not in the same kind of stratospheric place that the tech sector price earnings ratios were in the year 2000. Now, look, that doesn't mean there isn't going to be a substantial correction of some sort. No one can know that, and I certainly wouldn't want to claim that. But I think that those who have been saying it's all a big bubble and are declaring themselves vindicated right now are premature in their declarations of victory.
Larry, one of the things that the markets don't appear to be waiting for is a fiscal stimulus package, that so-called fourth round. Otherwise, they'd be waiting for Godot because it keeps going on another week this week without getting it. At the same time, we had a report of the CBO about the level of deficit, which is going to go over 100% of GDP for the first time since World War II. Do the Republicans up on Capitol Hill who are concerned about this have a point?
You know, David, what I learned from the CBO actually made me a little less concerned about a fiscal crisis and made me a little more focused on providing fiscal support for the economy than I was before. We all know that the United States ran a big deficit in 2020. We all know that the debt to GDP ratio, which was around 80% at the beginning of the year, is going to rise to around 100% because of that big deficit and because of the declining GDP. The thing I didn't have a bead on until the CBO report was what was the path going to be out for a decade. And what I learned from the CBO report is while the debt to GDP ratio is projected to go up slowly over the next 2 or 3 years, from 2023 to 2030, on current law and on current projections, the debt to GDP ratio isn't exploding. It isn't rising very rapidly at all. It's basically flat. And what that says to me is that we're in a relatively stable situation. Now, then you can ask the question, is it a dangerous situation? Well, there, I think the way you have to look at a debt is to look at the interest flows that it generates. And in fact, we're spending less on interest as a share of GDP than we have historically on average over the last decades. And if you do what economists would tend to say you should do, which is look at the real interest cost of the debt, that is the cost net of inflation, real interest rates are now negative, which makes it much, much easier to carry debt. So what I learned from the CBO is not the current deficit figures. They're in the papers every day. They're in the Treasury accounts. Right. What I look to the CBO for every 6 months is an update on the long-run debt path. And that was actually a relatively serene projection. So I feel better now than I did then.
But is that because of the Fed, Larry, to put it simply? Because if the real issue is the interest costs, right now we're approaching the zero bound in interest costs because of the Fed. Are we essentially financing that debt? Is this really a form of modern monetary theory?
I don't think that's quite the right way to think about it, David. I think that if most economists will tell you that, yes, the Fed can set the interest rate this year, or maybe the Fed can set the interest rate next year, but the interest rate on long-term debt, the so-called five-year interest rate, the interest rate that's baked into markets for borrowing that starts 5 years from now and continues for 5 years after that, that's not something that the Fed can immediately control, and it's remarkably low. I think it's fundamental factors about savings and investment that are determining the low level of interest rates, and the Fed is basically tracking that in its effort to keep the economy stable. And this is the secular stagnation idea that you and I have talked about on this show, or the low neutral interest rate that people in the Federal Reserve System have been talking about. I think they're fundamental factors that mean we're going to have lower interest rates and therefore can carry larger debts than we did historically.
Yes, fascinating. Thank you so much. It's always a treat to talk with you, Larry. That is Wall Street Week special contributor Larry Summers of Harvard, coming on a rather remarkable week. A lot of volatility in the marketplace, but maybe not telling us very much in the end. Finally, one more thought. A different kind of Labor Day. In the United States, we celebrate Labor Day this weekend, traditionally marking the end of summer and back to school. But originally, Labor Day had a bit more edge to it than picnics and beach parties. Starting locally here in New York City in 1882, it became a national holiday as part of President Grover Cleveland's efforts to calm labor strife that had led to deaths in 1894. This year, we celebrate Labor Day with millions upon millions of people out of work.
That's because there are no jobs in the economy. That is a consequence of the pandemic.
With back to school very much up in the air for millions of children, with warnings about the need to wear masks and keep our distance from one another.
There are areas of the country, part of the yellow zone and certainly in the red zone, when there's a lot of viral activity in the community. You have to take a careful look about if and how you're going to open the schools.
And with racial strife in cities around the country triggered by police shootings. But despite all that we're dealing with, happy Labor Day wherever you are and however you can celebrate it safely. Let's hope for a holiday next year we can go back to worrying only about getting a sunburn and eating too much. That does it for this episode of Wall Street Week. I'm David Westin. This is Bloomberg. See you next week.